Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Wednesday, May 12th, 2021, and I'm pre recording this Trading Places Live for Thursday, May 13th. Futures currently, they're showing some green after a really rough day on Wednesday. It does look like, at least for now, that maybe we'll get a slight rebound on Thursday morning. Dow futures currently up 120 points. The S&P 500 up about 15 points. NASDAQ up 53. So we'll see whether or not that sticks. So currently the NASDAQ showing a little bit more strength than the other two indices. We've seen a lot of weakness in the NASDAQ the past couple of weeks. I don't think we have seen the bottom yet. We'll talk about that in just a couple of minutes. Let me go ahead and walk you through the agenda for today. Got the daily market recap, then we'll get into talking technically. Talk a little bit about the inflation effect. Written some about it in the past. Got a couple charts I think you might be interested in seeing, and then I'll walk you through how the market is interpreting this right now. Then we'll get into the earnings spotlight, and we'll wrap up the show with the three you must see. Before we get into any of that, let me take you over to earningsbeats.com. If you are new to Earnings Beats, we'd love to have you join our free Earnings Beats Digest community. Simply type in your name, email address, hit that subscribe button. We'll get you set up. It is published 3 times a week, Mondays, Wednesdays, and Fridays. No credit card required. It's completely free, and you can unsubscribe at any time. Looking at the action on Wednesday, it was a rough day. Talked about the likelihood that the rising 20-day moving average would not hold as support given the reversing candle that we saw back on Monday and the negative divergences that had printed. So we had higher prices, lower PPO, not just on the Dow, but also on the S&P 500. We had a slight one on the NASDAQ, which has already played out. We've already moved down below the 50-day, and you can see the PPO has moved into negative territory. So all of the slowing momentum that we saw on the NASDAQ has played out, and we've actually now turned more bearish in the near term. Mid caps, slight negative divergence there. Small caps, not so much, but the selling really was across the board. Both the mid caps and small caps lost more than 3%. NASDAQ 2.7%. S&P a little more than 2%, and the Dow 2%. Another 681 points on the Dow. So just Monday up above 35,000. Now we're all the way back down to 33.5. 1,500 points gone in just a couple of days. Moving on to the sectors, energy, the only group in the positive on Wednesday. We saw a slight gain on energy. It is still staying above its rising 20-day moving average, which has just recently crossed back above its 50. So I would say that this is one of the stronger sectors at this point, if not the strongest. And as long as the trend continues to the upside, I think this is probably one of the safest areas on the long side. Not so safe would be your discretionary and your technology groups. Both now are trading below the 50-day. The technology group on Tuesday had gapped down below the 50, but rallied. Looked like maybe we were trying to put in some kind of reversing candle. Didn't get back up above the 50, but did print a hollow candle. Well, that was negated with the action we saw on Wednesday. The discretionary group, which had tried to hold on to gap support from back at the beginning of April and also the 50-day moving average, did that on Tuesday. Did not do it on Wednesday, though. Very heavy volume, and we did see some selling. Home builders, one of the big losers or the biggest loser among the discretionary stocks. And in 2 days now, you can see we have lost probably about 12% on this index. We did have a reversing candle on Monday, and we have followed that up with a lot of selling. We had a negative divergence in play that's now played out down to the 50-day moving average, but it certainly looks like we have at least some more short-term selling to go on home builders. Another group that was hit hard, and this is a group that's been very strong of late, steel, the steel industry. After moving up almost every day for about 2 or 3 weeks, we saw our first really solid day of selling. Now, I would expect the rising 20-day moving average to hold this group at least temporarily, and then we'll see what, if it has anything left in the tank. But after the reversal on Tuesday, and then the big selling on Wednesday, I would think that we probably have that rising 20-day test in the cards probably over the next few days. All right, let's keep moving on. Move to the 10-year Treasury yield. So Wednesday, we had some really poor CPI news. So inflation at the consumer level was much higher than expected, rising 0.8% in April, and the market was only expecting 0.2. I don't know why the market was only expecting 0.2. Just about everywhere you look, prices are going up. The core PPI, if we strip out the food and energy, had risen, I think, 0.9% in April versus just 0.3 expected. So a huge jump in inflation, and that was the headlines on Wednesday that created all the selling. This is something that I've spoken about for the last couple of months. These numbers were coming, and I'll show you an article in just a couple of minutes. When we get into that inflation segment, that'll show you why these numbers are coming in the way they're coming in. And we're not done. We've got the PPI due out on Thursday. Right now, looking for April PPI to come in at a 0.3% increase. March was 1 full percentage point. I think the April number is going to be higher than expected. April core PPI expected to rise 0.4% after March had gone up 0.7%. Again, I think the numbers could be higher. We'll see. Initial jobless claims also due out in the morning. 475,000 is the expectation there. But when you look at the market reaction, the bond market reaction, huge move up in the 10-year Treasury yield back to 1.70%. And we're still in this range, but I think we're quickly moving back up to challenge that 175 level. And if we get a hot PPI number in the morning, that could be all it takes to get us back up there. So that'll be something to watch for in the morning. Let's move on to talking technically. So talking technically, what I wanted to do is walk you through these weekly charts on the major indices first. So we got the Dow Jones Industrial Average, and it is still midweek. We got 2 more days to go before this candle finalizes. But you can see that's not a very good looking candle right now, bearish engulfing. We'll see if that continues through the end of the week. Looking back since the virus vaccine news came out back in November, we have not even tested the rising 20-week EMA on the Dow Jones. So we've lost 1,500 points in the last 2 days. Another 1,500 points would take us below the 20-day. We've got about 1,100 points left to get to that 20-day. So it certainly seems with momentum to the downside, and this inflation talk is not going to go away anytime soon. We do, the market, I think, will kind of, push it under the rug, the carpet, sweep it under the carpet down the road. We'll get back to a little bit more normal trading, but we're going to have more issues with inflation in June when the numbers come out next month. And again, I'll talk about that in just a bit. But I would expect anyway, a test at least of this rising 20-week EMA on the Dow. S&P 500 looks very similar. Still, the PPOs continue to put in higher highs, which is good. But we've seen a lot of selling so far this week, and it seems like another test of this rising 20-week EMA is likely in order. Moving down to the NASDAQ, we have a completely different animal here. So the NASDAQ putting in that double top, the weekly PPO definitely has rolled over. And I would not be surprised for the NASDAQ to see at least a 50-week test. That's another 1,000 points or close to 1,000 points from where we are right now. You can see that 50-week moving average right now down right about 12,100. When you start talking inflation, even if it's just a temporary scare, folks move out of growth stocks. And that's primarily what comprises the NASDAQ. So you've got to be careful with the NASDAQ right now. I think we're going to see a lot of volatility. We'll probably see some big bounces in both directions. We'll see recoveries, we'll see rebounds, but then I think we're going to see probably more selling before this is all over. At a minimum, I would expect to go down and test the lows that we saw back in March, which would be down just below 12.5. That would be another 4% or so from where we are now. That would be kind of like a minimum downside target. But I think we could probably even take that out, scare a lot more folks before we begin to resume an uptrend in the market. The small caps, pull that chart up here. You can see that PPO is rolled back over again. We're going to see we've got a pretty good test that's going to come in around 1250. That's been the recent lows. And you've got that 20-week moving average at 1272. So I would think that range is what I would be watching. If we break below 1250, I think that could definitely lead to some more short-term selling in small caps. Mid caps, much the same. You can see that PPO starting to roll over a little bit. Don't like this candle so far. Let's look for the 20-week EMA and then that recent low back in March, just below 2,500. I think that, and then the 20-week EMA, which is around 2,550. I think those are the two levels that we're going to want to watch and are likely to test here in the near term. IWF IWD is the top part of this chart. The NASDAQ versus the S&P 500 is the bottom part of this chart. Now, I've broken this up into three different areas. The first one here was back on September 3rd when we first got some serious warning signs during the secular bull market advance that we had in 2020. And one of the charts, or excuse me, one of the articles that I wrote on September 3rd was talking about some of the key warning signs, looking at the sentiment indicators. So we had the VIX, and anytime you get the VIX going up at the same time the S&P 500 is, you get this positive correlation moving above zero. You got to be a little careful because sometimes this perfectly times tops in the market. And so back in September, I wrote about it and we topped right then and there. If we look at this chart, update it to currently, you will see here is where we talked about in September, and you see what happened. It wasn't a bear market. It wasn't a long-term bear market. It was just time for the market to pull back and consolidate for a while. Now, we had a couple of other moves into positive territory that were not quite as, they certainly didn't send the same signal. But this last one, you can see where we went above the zero line here on the correlation. We started to show positive correlation again. You can see that pretty much marked the top as we roll back over again. So some of these same issues that we saw back in September were beginning to surface again here in May. Also, put call, I wanted to bring this up because the put call was very complacent back in September. If we look at the most recent here, you can see actually the 5-day moving average of the equity only put call ratio is the highest it's been since back in November. Now, it's not high by historical numbers, but it's the highest it's been. So this sentiment indicator would suggest that maybe if we keep seeing selling, you might see this shoot back up into the 70s. And if it gets up in the 70s, especially up into the 80s, these tend to mark bottoms. I rely on sentiment indicators that are suggesting bottoms. I think they're much more reliable than sentiment indicators that suggest tops. I mean, if you look back and you see almost every major bottom, you look and you see what the sentiment reading is here, because there's a lot of money at stake for the market makers when everybody's buying puts, and that really starts to come out and you start to see these huge spikes in the 5-day moving average or the equity only put call ratio. The higher this ratio goes, the more puts that are being traded relative to calls. So look at the bottoms in the market and look how they coincide. Now 90 and 1.0, I mean, those are extreme levels that we don't typically see unless the market has really fallen apart. But I think if you look at these other tops, you get into the 70s, between 70 and 80, many of these mark fairly significant short to intermediate term bottoms. And so I think it's really important to continue to watch this. If the market continues selling off, we have a rough May. This is an indicator that can help us mark a bottom. All right, let's go back there. So that was one article that I had written, and I just wanted to point out, okay, so this is when we topped growth versus um, value stocks. So this was back in the beginning part of September. The next arrow that I'm pointing to here, this is November 9th. This is when the vaccine news came out, the positive vaccine news. And that kind of changed everything because that started the whole thing about, okay, we're going to be reopening again. So money began to rotate a little bit toward the reopening stocks, and the growth stocks never did move to another high after that. So we kind of meandered along. You can see some pretty significant bottoms here, down around 1.69 on this ratio. Also, the breakout that we had back in June was clearing 169. So that was prior resistance, relative resistance, which becomes relative support. That broke back on February 22nd. And since then, we have had a couple of really rough periods with growth stocks. You can see the end of February and early March, that big drop in this ratio. Also, the NASDAQ versus the S&P 500 lost its trend line support at that exact same time. And that's what created a lot of weakness on the NASDAQ back in February and early March. Well, we're back there again. You can see over the last 2.5 weeks, the selling has really picked back up again in growth stocks relative to value. Now, the overall market had a rough day today, and we're starting to see, this week has been a tough week for the, just about everywhere. But on a relative basis, growth is getting hit much harder than value. And I'm watching this 155 level right here. I think that would be another warning sign about growth stocks if we cannot hold this support level. The NASDAQ versus the S&P 500 has already lost its March lows. So we're already seeing that money moving away from the NASDAQ. Growth is trying to hang on. And again, this is a pretty key level when you start going back a year and you've now got a triple bottom. You really don't want to lose this support if you're a fan of the growth stocks. Now, I believe growth stocks, even if we lose this support level, I think they'll be back later in the year, but we may have to suffer a lot more in the growth stocks on a relative basis before the end of the year if this support level gives way. So something to watch for. Now, in addition to the warnings that I issued back in September, I also did talk. This was an article I wrote on May 1st. So this was just 11 days ago. And I wondered if it was a sell on the news top. Back on that day, that's when Apple and Facebook both reported earnings. But the things that bothered me then and still bother me, number one, we had overbought conditions. And here I point to on a, now this is a weekly chart. So this isn't just daily overbought. This is weekly overbought, which doesn't happen quite as often. You can see the big top back at early January occurred when we were way overbought. Now, even after we hit overbought levels, you can see we went up for another few months. Here in, I don't know, latter part of September of 2018, as we headed into the fourth quarter, trade war hit, but we were up very close to that RSI 70 when we topped there. And then you can see in February of 2020, right before the pandemic, we were overbought. So all of those things led to some selling. Well, where are we? Well, 11 days ago, we had an RSI at 71 in overbought territory. Weekly RSI at 71, which just tells us we're overbought. It doesn't always mean we sell off. You can go back and see we've hit 70 before, and we've continued going higher for a period of time. But it is at least something to be considering. It was one piece of the puzzle. The NASDAQ failure at resistance with a negative divergence. I don't know if you saw my two-part article that I wrote about divergences a while back. If not, you should probably scroll back through my articles and take a look. This is one of the things you've got to be careful of. When you have a false breakout, negative divergence, and it occurs at a very significant resistance level that was tested prior, that should be respected. And I think what I wrote here at the bottom of this, and you can see this is when the news came out. This is a 5-day chart. Came out, we were up over 14.2 on the NASDAQ. And the next 2 days, it was this big sell-off for a couple hundred points. We're now almost 1,000 points below that, probably about 900 points below where we were then. Now, the question I posed here was, eventually we'd get through that 14.2 and it'll be bullish, but have we topped short term? And my answer to that question was yes. Until you're proven wrong, you have to expect that we're going lower, and that's what we've been doing. Rising volatility, S&P 500, when it goes up and we see these spikes in the correlation, this is what I was just talking about a couple minutes ago, you've got to be careful. And if I update this chart over the last 11 days, you'll see that we did finally, as I pointed out, break above into positive territory. And that can be very timely with a market top, as you've seen on many of these. There's 5 prior instances. Now, do they all work? No. But when we see that, you should at least be thinking, okay, this is another bearish piece of the puzzle. Because to me, that's what it comes down to. How many bearish pieces can you find? If you find one and that's all you've got, chances are that's not going to be a problem. But when you start stringing them together, that's when you've got to start to become a little bit more focused on the possibility of a sell-off. Historical performance. Been talking about this a lot lately. During the anticipation of earnings and then during earnings season, stocks historically go higher. April 1st to May 15th. Annualized return on the S&P 500, 14.48%. Keep in mind the S&P 500 average is going up about 9% a year over the last 70 years. So if you have an annualized return of 14, this is a period that does about 50% better than the normal period throughout the year, which is good. The flip side, though, is the second half of the quarter tends to be much weaker, gaining an annualized return of only 1.7%. And so you've got 45 days. Well, it's May 12th. Tomorrow's May 13th. I mean, we're just about there. So that's getting us pretty close to a period where the market historically doesn't do that well. I also mentioned earnings reactions, and for Earnings Beats members, I'm still trying to get this spreadsheet finalized. I'll give you a new version here, hopefully in the next couple of days. But you can see technology has been performing horribly after earnings. And the intraday move, you can see also consumer discretionary has not been very strong. Materials been kind of weak after those earnings come out. So these are just some of the things that we need to be thinking about. So that was just a handful of things that said, hey, we've got to be very careful as we head into this period. So I'm not shocked to see the market struggling here. In fact, with the inflation news coming up, I think that's something that's probably going to stick with the market for a while. We're not going to get past these inflation stories probably for at least the next couple of months. And that's going to make it more difficult for the market to go higher. All right, so let's move on. I want to talk a little bit about this inflation. And first, let me move on to an article that I wrote in Chart Watchers back on March 12th. And back then I said, hey, rising inflation is coming. It was just simple mathematical calculation and certainty that inflation was going to rear its ugly head. But the question is, how long would it last and what kind of an impact would it have on the market? Now, the reason why I'm saying it was a mathematical certainty is if you look back at the readings, we had 3 negative readings when the pandemic first hit. Now, does that mean that we had deflation? I mean, we had 3 straight negative readings. That's a sign of deflation, right? Well, no, because we had a pandemic that caused it. It would never have happened if it wasn't for the pandemic. Well, now we're getting to the point a year later where we're getting the flip side of this. And so as we move each month, we're getting rid of one of these months that was negative, and we're adding to it a month that is now very positive in terms of, like I said, I said it earlier, April CPI came in at 0.8%, as opposed to the expected 2, and core was 0.9. So April on here was 0.9. I think March was less. I want to say it was like 3 or 0.3 or 0.4. I don't recall. But 0.9 was April. So when you start replacing these minus readings with big positive readings, this year over year number is going to jump. And that's what, we were taking a look at back then. I mean, you can see this 12-month rate of change had spiked back in 2004 to 2006. It had done the same thing in 2011 and into 2012. This was going to be much faster. You want to see what this looks like now? Look at the surge in the CPI, the core 12-month rate of change. This is as of April 1st. This doesn't include the one we just got today. I think the year over year I saw was like 4.4% or 4.2%. So the question is this something that's short-term, transitory, as the Fed says, or is it something that we need to be more concerned about? Well, the headlines are telling us, and of course the headlines are always going to be screaming negative stuff to us because they need clicks. It's all clickbait. But the key is going to be watch the market and how the market reacts. Interest rates went up. That happens with strength in the economy. It also happens with inflation rising. So just looking at that by itself doesn't tell us everything, but it is something that we need to be, well aware of. I just want to point out real quick that with this scare over the last month or so, I took a look at the industry groups, and you can see energy and materials dominating the last month's worth of relative performance. So those are areas I would continue to consider on pullbacks. Just make sure that if they break down, you keep your stops tight. It can be very, very volatile this time, heading in and moving through an inflation scare. The weak areas over the last month, now that says XLE, but it's renewable energy, which is really technology. The 18 worst groups over the last month are all part of the top 5 aggressive sectors. So technology, consumer discretionary, communication services, industrials, and financials. They make up the top 18 in terms of the worst performing groups over the last month. That's what's killing the growth stocks right now, and why we're seeing value outperform with energy and material stocks doing much better. All right, let's move on to earnings. I don't really have a whole lot after hours, but let me just show you a couple of them real quick. Earnings spotlight, we've got Amdocs, not really a great performer, big drop there. They did miss a $1.13 versus a $1.14. Stock was up 2% after hours. The big winner, and this is one of our portfolio stocks, unfortunately, stock's been getting hit very hard for the past couple weeks, like most growth stocks, but they came in, they beat 31 cents versus a loss expected of 22 cents. They came in at 31-cent profit. Stock's up 14% after hours, so hopefully we'll get a nice boost there. Moving on, last thing, 3 you must see. I'm going to go through quickly here. 3 FAANG stocks. First, Facebook. Facebook gapped up with earnings, has been selling off. Held up better than most, though, and now we're down to 50-day and recent price support. Let's watch to make sure this holds. Next up, Netflix. Netflix gapped down with its earnings. It's continued to drift below the 20-day. Until it gets above the 20-day, I think this is a stock you avoid. Finally, Google. Google also has been weak over the past couple of weeks, but it's held up fairly well relative to the overall market. Watch the breakout level at 2100. Any kind of a close below that, I'd be careful. Also, watch if it bounces. Can it get through the 20-day? Failure there would suggest maybe we have a downtrending stock. All right, that's it for me. I appreciate everybody tuning in. I'll be back next week on Monday for your next Trading Places Live over at earningsbeats.com. That'll start at 9 a.m. Eastern as always. Everybody have a great day. Thursday, Friday, enjoy your weekend. I'll be back next week. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.